This is 93 Million with Doug Andrew. Welcome to 93 Million with Doug Andrew, where we talk about how to optimize your assets, minimize taxes, and empower the three dimensions of your authentic wealth. My name is Greg Dukowitz, your host, facilitator, and IUL specialist. And in today's show, we're talking about market volatility, money in life insurance, whole life versus IUL, and more. And we're joined by the OG of properly structured IUL, New York Times bestselling author of the L.A.S.E.R Fund, Doug Andrew. Welcome, Doug.
Good to be here, as always.
Co-author of the L.A.S.E.R Fund, IUL mastermind, and creator of the tax-free tools. Welcome, Emran Andrew.
And better looking than Aaron.
No. Also,
and better than looking than
also co-author of the L.A.S.E.R Fund, the IUL Einstein, and a man who's better looking than his brother. Wait a minute. How did I get in here? What?
Thank you, Greg.
Well, Aaron Andrew? Welcome, Aaron.
Hi, everybody. Welcome to the show.
Welcome to the show. Good to have you. And our featured host for today, president of L.A.S.E.R Financial, original convert from whole life to IUL, and a man who once got lost in the ocean, Brandon Johnson.
I've never had a bad hair day before.
Yes, great.
Glad to be here.
All right, gentlemen, we have a lot to get to today. I'm excited for our topics today. So first segment, dive, the fickle nature of the stock market. So according to TheStreet.com, on March 9th, 12th, and 16th of the year 2020, does that ring a bell for anybody?
I remember those days.
Yeah. The stock market respectively lost 7.8%, 9.9%, and 12.9% on each of those days alone. If you add up each of those 3 days, it's a total of 30+% in combined losses. That's a lot of losses on just isolating 3 days. Of course, that was the days of COVID, and a lot happened in those early days of 2020. So, Doug, the question for our group today is, why do world events or news stories affect the stock market so much?
Oh, yeah. It's amazing. It's like a domino effect. And I remember the market reacting to all kinds of events, the space shuttle blowing up, okay, the tsunami in Thailand, and shootings in Canada.
Yeah.
But I remember 9/11, okay? And the fact of the matter is, more people during and right after 9/11 terrorist attacks, more people had died in bathtub accidents than had died in hijacked airplanes. But people stopped flying immediately. Yeah. They stopped going out to dinner. They stopped traveling. They hunkered down. They stopped investing. And the market just bam. Wow. And it took 3 years while everybody was rubbernecking on the economic freeway. So it's like a domino effect. Whenever anything happens, I mean, right after Trump was elected, the market surged.
Right.
Because
one news story.
He's pro economy, and right. So it surges, and so it's amazing how fickle it is, and so you've got to be in a position where you're protected from those whims in the daily market, because this in March of 2020, when there's anxiety, there's opportunity, and we've shared in other segments, our clients seized an opportunity the next year and locked in gains of 61.33% after that 30% loss.
All right. Yes, we did talk about that in another segment, and we'll talk about that again probably on another show. So, Emran, let's go to you. Why is the stock market so fickle? What causes that?
Well, I mean, the market is numbers. It's all numbers, right? And if it was just staked to numbers, I think we would take the fickleness out of it. But when you have these events, COVID or 9/11 or anything else, it brings emotion into it.
Yes.
And emotion overrides and trumps logic.
Right.
And whenever emotion trumps logic. And as soon as it hits there, everybody doesn't want to lose. I mean, if you've got your serious cash, I'm talking about money you cannot lose. You can't afford to lose.
Right.
And it's in the market and it's losing, you're freaking out because you can't afford to lose.
Right. And people think they'll wait it out,
yeah.
And they'll be logical, but the studies show people are not logical.
No, because I can't lose. I got to do what? I got to rip it out of there. I got to rip it out of there, which is just going to cause it to further drop. And,
Yep, absolutely. Aaron, what are your thoughts?
Well, just going over this, like basically this, we are a world economy, aren't we?
Yes.
Everything's tied together.
Yes.
So,
especially with networking and internet and all that stuff.
Everything. I mean, think about what happened last year. It was August 5th of 2024.
Yeah.
when the market
Good
crashed. There was
example.
stuff going on in Japan,
Right?
And that,
The yen or whatever.
yeah, and that caused like things to trickle down throughout the world economy. Market also had a little tank, and I think it was December 18th. And it's just like something happens across the world, and it causes a ripple effect, as Doug was mentioning, because we're so connected. We're so all the economies are kind of tied together. And yeah, anything can happen that could cause things to just.
And you could be the most efficient company with numbers in the black and looking good and looking positive.
Yeah.
Something happens across
good
the world.
returns in your
Yeah.
company, and you could have your market that's your stock go down with everybody else's.
Right, just because.
And yeah, just because it's just amazing how much can be can happen in a day.
Yeah. Brandon, what are your thoughts? Wrap us up on this segment. will
Yeah,
you?
I mean, we're emotional creatures, right? We feel fear and panic, and everybody, it's almost contagious. When the market's going down, everybody's like, oh, I better hold on. I'm not going to buy that new furniture that my wife wanted or the car. But when people are feeling confident and your job's going well and you see the market doing well, you're like, you have more confidence. Hey, I'm going to buy that furniture that my wife wanted, or that new couch, or maybe buy the new car, or, put the yard and whatnot, and you're going to spend more money, and it just has this effect on the economy overall. So I think we all it's such a contagious feeling that we all feel this panic and confidence all
Fear is
together.
more contagious than hope.
Clients in retirement,
Sadly.
clients will do that. They will be like, I'm not going to spend money this year as much. Market's down, market's up, I'm going to spend money.
Yeah.
It happens all the time.
Very emotional. So, all right, well, let's get on to our next segment. But first, just a reminder that if you enjoy this content and you want to see more of it, please like and subscribe. And if you'd like to ask us a question, please comment on this video, and we may use your question in one of our next shows. Wouldn't that be cool? All right, next segment, life insurance. Are you crazy? The debate about using life insurance as an asset will probably never end in our lifetime. We spent a previous segment where Dave Ramsey calls Index Universal Life Insurance crap. If you saw that segment, that's was an entertaining segment.
We did not agree with him.
Yeah, spoiler alert. But according to a JP Morgan Wealth Management article titled How to Use Life Insurance as a Financial Asset, they say that, quote, some life insurance policies can become a financial asset for you to use during your life, just like an IRA or mutual fund, unquote. So, Doug, how did using life insurance as an asset come into existence? Why should someone consider it? How does this? A lot of people hear about the word of life insurance. How do you put money in life insurance? It sounds like such a foreign concept. Can you explain why it is in existence?
Yeah, because originally people bought life insurance to pay off in case of a premature death or untimely death. And that's pure term insurance. But then whole life came around, and that's where you pay a much higher premium, but it's a level premium for your whole life. And what you're doing is you're way overpaying the early years,
Right.
so that you're underpaying the later years.
Because that extra in the early years isn't all needed for cost, so they take the rest of it and they would kind of invest.
And that builds up equity, or what is called cash value.
Right.
Okay. And then all of a sudden, people started going, well, that cash value, it's treated by the Internal Revenue Service as tax-free.
Yeah.
Why do they want to hurt where people are trying to take ownership? And if they die, why would they want to make something taxable when they're leaving behind money to their widow or their orphans? And so it's been a tax-free, actually cash cow in the Internal Revenue Code.
Yeah, since the income tax came about around 1913.
Yeah, but whole life was really designed basically for death benefit to cover you for your whole life. Well, in 1980, that's when E.F. Hutton was the brainchild behind the emergence of universal life, and they said, wait a minute here. This is tax-free.
Right.
There's three sections of the Internal Revenue Code in one form or another since 1913
Yes.
that allow you to accumulate money tax-free inside of permanent life insurance, Section 72E. 7702 of the code says how you can access that money while you're alive without triggering tax.
Right.
And then at the end of the day, when you finally die, Section 101A talks about how whatever you leave behind, it transfers, it blossoms, it transfers income tax-free. Now, nothing else does that in the Internal Revenue Code, and E.F. Hutton realized that.
Right.
And then that's when they said, well, instead of paying a whole bunch of premium for 10 or 20 years into a whole life policy and then hopefully you're done,
Right.
why don't we just fund it in one fell swoop? Why don't we fund it in 4 or 5 years? And let's do the reverse. Let's take the least amount of insurance we can get away with and put in the most money the IRS allows as fast as they allow. And let's use it for living benefits. It turns into using life insurance cash value as an asset for tax-free accumulation and tax-free income so that every $1 million can generate 70, 80, 90, 100,000 a year of tax-free income. And that's the whole purpose behind E.F. Hutton coming out with universal life.
Yeah.
Living benefits became the primary objective. The death benefit was secondary.
So it started out with people prepaying premiums essentially so that they didn't have to pay those at the back end of their life. And that kind of snowballed into this, well, how much can we prepay? And then more and more. And then it was just giant amounts for minimum life insurance and with all these tax advantages.
Yeah, and they had to come out in 1980 with a few tax citations because people were abusing it too much. So
Yes.
people had to have a commensurate amount of insurance. You can't put $1 million in a dinky $10,000 life insurance
Right.
policy.
You had to have it. It had to qualify as life
And
insurance.
so, but that kept it tax free in the Internal Revenue Code. That's
Right.
the beauty of it, because if you violated that, you went over to another section of the code called investments, and investments are taxed sooner or later,
Right.
and they're subject to volatility. If that's the definition of an investment, which is what the financial services industry says it is, I don't want one of those.
Right.
I want tax-free insurance.
Right. That's a really good point. Brandon, what are your thoughts on this?
Well, I love that whole concept that, when everybody thinks of life insurance, and this is what I always thought, forever is you think of a number in mind. I need $1 million to protect my family. I need $500,000.
Right.
What's the premium to pay for that? Right. And with max funded tax advantage life insurance, we just flip that right on its head and just say, well, what's the least amount of death? I don't really care about the amount of life insurance.
Right.
If I'm putting this much money in to grow tax free, what's the least amount?
Right.
Because I want to maximize the cash accumulation in this financial vehicle, make it as efficient as possible. It's all about efficiency. And it's beautiful when you see a plan come together, you design it right. These things are awesome.
So good. And even most professionals don't even understand that concept, right? Minimum death benefit and trying to maximum the premiums, all that kind of thing. Aaron, what are your thoughts on this?
To add to all this, I would say, how it came to existence is the safety aspect.
Yeah.
We talked in another segment about BOLI and COLI, bank-owned life insurance, corporate-owned life insurance,
Right.
and how, this came about because, these institutions have been around for a long time. The companies we use, for example, have been around for 100 years, 150, over 100, it's 160, 170
Yes.
years.
With high safety ratings.
Yeah, extremely high, way higher than banks and credit unions. So I think also this has become so popular over the years and in the early 80s and so forth because the safety of the institution, that our principal's safe, it's protected. The insurance companies are putting money into safe, secure places. Like when 2008 happened, tons of banks went out of business. 0 life insurance companies went out of business. I think the safety aspect is a huge component that made it real popular.
Yeah. Emran, life insurance as an asset. Wrap us up on this topic.
I mean, you really watch where the money is, and it was the affluent families. We oftentimes, if you really study especially life insurance, one of the big names always comes up, the Rockefellers.
Right.
Right, and they've always done this, and I love it because it goes just down to the core principle. When I talk about, I like to refer to it as self-insuring, right? And the affluent people self-insure themselves, and when you take accountability and responsibility for your own, taking care of your kids, your grandkids, all those you're going to leave behind. When you take accountability and responsibility for it rather than pushing onto somebody else, you get to reap rewards for that.
Right.
And the rewards are tax-free, tax-free, tax-free.
I mean, you mentioned Rockefeller, Walt Disney, JCPenney. Didn't Walt Disney pay his staff with his policy?
Yeah,
guard against
who's the
it?
Michigan coach we reference sometimes?
Jim Harbaugh.
Jim Harbaugh, right?
Yeah, he negotiated a nice policy to be in there for his his contract.
This is great. Yeah, and we did talk about COLI and BOLI in another segment as well.
Yeah.
All right, if you're enjoying this content and are wondering how to take advantage of these ideas, how to take control of your financial future and get on the path to lasting wealth, at L.A.S.E.R Financial, we help individuals and families like yours implement proven strategies to grow and protect your wealth. Strategies that don't rely on risky markets or high taxes. One of our most powerful tools is the Index Universal Life Policy, or IUL. It's not just insurance. It's a tax-free retirement strategy, a way to grow your money with compound interest and a safety against market downturns. Imagine this. During retirement, your money grows when the market goes up, but when it drops, your principal stays protected from those market downturns. And because IUL strategies can be structured for tax-free income, you get to keep more of what you've worked so hard to save. Whether you're planning for retirement or looking to secure a financial legacy for your family, we can show how IUL can make all the difference. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. That's laserfinancial.com or call 801-505-0409. Don't wait. Take the first step toward a brighter, more secure financial future today. This content is also brought to you by IUL Insiders. Hey, listen, if you're a financial professional tuning into the show and you're wondering how you can expand your business working with Index Universal Life or IUL, just like what we've been talking about, you already know it's one of the most powerful tools in the industry. But let me ask you this. Are you leveraging it to its full potential? That's where IUL Insiders comes in. They've trained thousands of professionals like you to go beyond just selling policies. They show you how to build a thriving, scalable business that sets you apart from the competition. In the next few weeks, they're hosting the IUL Challenge. It's a free 3-day event designed specifically for financial professionals who want to master the art and science of IUL. You'll learn proven strategies to market, design, and sell properly structured policies that deliver incredible results for your clients and for your bottom line. If you're ready to elevate your practice and scale your business, visit IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. All right, showdown. Whole life versus IUL. Oh, baby. You've been waiting your whole life for this discussion, gentlemen. Wah, wah. If you go online and you do a simple search of Index Universal Life or IUL versus whole life, you won't be lacking in results. In fact, you could get lost in an online data dump of endless and frankly unhelpful words forever. The problem is there's too much info and not enough wisdom, and you'll get all kind of sides on this. It's hard to know what's true and what's false or who to believe, right? Brandon, I want to start with you on this because you've spent much of your life in the whole life sphere. I kind of joke in the intro, you're a convert from whole life, but you've had a lot of experience with whole life and now IUL on that side. What's the difference between whole life and IUL?
Full disclosure, I own whole life and I own IUL.
Both of them.
Whole life and I've sold IUL.
Yeah.
So I kind of have a unique position on this, but at the end of the day, my clients that if I talk to them and said, well, do you just want a very safe, predictable 4.5% every year? You know what it's going to be. Doesn't matter what the market's doing. Do you want to be a little more aggressive, have a little more upside and have years where you're 12%, 15%, 61%, 2020 to 2021, thanks to Emran who emailed our whole database and made a lot of people money that year and made a certain carrier pretty upset. No, just kidding.
have the right person on your side.
But that's the thing is, like, does the client want upside? Do they want growth potential? Do they want a little more exciting returns? Like, I love getting statements, maturity statements in my IUL. I'm not excited to get statements with my whole life. I'll be honest with you. Right. It's just, it's boring.
Ooh, did the dividend move by 0.2%?
Right. So at the end of the day, I love the upside potential. I'm already going to get a zero floor, guaranteed zero floor. So I'm already
lots of protection still built
on the
in.
downside. So I love that about IUL versus whole life, if I'm being honest.
Awesome. Yeah. Aaron, what are your thoughts on IUL versus whole life?
Well, I'll get try to keep it simple but get technical.
Yeah.
I like to get in the numbers, as you know.
You like to stir the pot, be honest.
So, I mean, looking at whole life versus IUL is one thing that, whole life does not disclose is the fees. You don't know what's going on with whole life. It's all behind the curtain. You don't know what's going on. You get your statement. This is how much cash value you have. You don't know the cost.
Yeah.
The true cost. It's just like, okay, you have a dividend. Sometimes they don't even tell you the dividend rate. It's just like, this is your amount.
Yep.
So basically, the best thing to do with IUL, everything's full disclosure.
Yeah.
All the fees, expenses, your return.
Cost reports if you want it, all itemized.
Everything. Before you buy and, afterwards, it's all there.
Yeah.
Okay, so the best way to compare the two, if you want to compare fees, a lot of clients like to dig into the fees, engineers, is you run what's called an internal rate of return report.
Yes.
IRR, stands for internal rate of return. Don't have time to talk about it too much today.
Right. Another show.
Yeah, but basically, you go out like 30 years as an example, and you calculate, the gross return versus the net IRR, and guess what? Almost all the time, whole life is about twice as expensive as IUL.
Right.
All right? And that's how you figure that out, is running an IRR and running that report, and you kind of see that IUL is cheaper because it discloses all the fees and expenses. It's got better return potential. Yes, whole life's got better guarantees. I'm okay with that. All right. If you feel like these things are going to get the guarantees, don't get either one. Okay.
And if anybody
Just
ever asks
disclosure.
why is it cheaper? Why is it cheaper? It's because again, the amount of insurance I'm paying for can be significantly less.
Yes.
It's not just the fact that it is cheaper. No. It's cheaper for a specific reason.
Because
Not
of the
just
structure and the way you can structure it.
Exactly.
Yes.
Because I'm not paying for this amount of risk over my whole life.
Well, sometimes getting some details again, like sometimes they say, oh, it's going to blow up when you get older. Not when you design it correctly. And when you do it correct, you look at it, it's actually the whole life that's more expensive in those years that you don't know what's going on behind the curtain.
Yeah.
You look at the cash value comparisons.
Yes.
And you see that IUL just like, when they say it blows up or has problems,
Yes.
it's the whole life that lags and the IUL takes off when you look at an illustration because
Right.
it has lower cost.
Yep.
It has lower fees and expenses.
Properly structured IUL.
Yeah.
Yeah, and that's what I was
properly
going to say.
structured.
Properly structured is really important, right? And Emran, you've talked about that in other shows where we go through. We
Yeah.
talk about structure and how important that is. So that's what we're talking about. Baseline.
Yeah, it's gotta be done right.
Yeah, make sure we're all on the same page. Doug, wrap us up on this subject: IUL versus whole life. What are your thoughts?
Well, again, as I mentioned earlier, whole life was primarily designed for death benefit. Okay, can you accumulate money to be used for life? Yes.
Right.
But Index Universal Life was designed specifically for that.
Yeah.
So as Emran has often taught, you self-insure. See, oftentimes when we maximum fund an IUL policy, the cash value will grow to equal and then exceed the death benefit within 10 or 15 years. Okay? Why do you need a guarantee that the death benefit will stay in force when your cash grows to equal and then exceed it because you've self-insured? Going back to what Aaron was saying, it's twice as expensive. I can earn, by diversifying and rebalancing, 9% on IUL. And if I own that IUL for 25, 30 years, and I look retroactive back to day one, my IRR, internal rate of return, is about within 1%. If I earn 9, I net 8, cash on cash, so to speak, okay?
Right.
Whole life, the best I've ever seen, is a whole life Northwestern Mutual, assuming it paid 8%. But it took until age 95 to earn, if it earned 8, it only netted 5.9. So it was draining out 2.1 percentage points, whereas IUL, by age 65, was only draining out 1. So whole life was twice as much. It was draining out 2 of 8 percentage points.
Yeah.
Ours are draining out 1 of 9 percentage points. Does that make sense?
Yeah, and it's interesting when you add income into this equation, right? Actually pulling income out.
Seriously.
It is majorly different.
What are you? Yeah, if you're
It's
just
a
saving
huge
money,
difference.
if you're just saving money,
Yeah.
whole life, great.
Right.
But if you're saving money so that you can
have a tax-free
access
income,
it,
yes,
right? If you want to access the money,
Yes.
huge
In
difference.
fact,
Well-
all you do is tell somebody, put this much money in, take the least amount of insurance,
Yep.
take it to age 65, and show me the maximum income to age 120.
Yeah.
And
Compare
whole
those.
life can't even
Well,
come close.
they don't illustrate income half the time.
I know.
90%
Most
of the time
that you
they
don't
don't
see
even
those
illustrate loans because they don't look good because IUL has way better loan features. We talked about that a lot in our last episode.
Yeah.
But basically, yeah, the loan features are so much better in IUL compared to whole life also.
All right, we could go on and on about this, but coming up, how did Brandon get lost in the ocean? But first, on to our next segment. Money has to have a home.
Oh, why didn't you just go home? That's your home. Are you too good for your home?
Okay, Doug, you've often said that money has to have a home. In a previous segment, we've touched on risk versus return, but where do most Americans put their wealth? Well, according to GoBankingRates.com, most Americans store their wealth in 401ks. If you look at this graph, it's neatly shown right there, about 28% in 401ks. But there is more to this story. Aaron, when you look at this graph, what do you see?
Okay, one thing I want to point out is right away, look at the orange on the left. All right,
The 22%?
Yeah, the 22%, that's checking accounts, basically. And then the yellow at the bottom, 18%, that's, savings, right?
Right.
And then you got the 4%, the dark blue up there is CDs. So that's all basically in what kind of institutions, you guys?
That's the
Banks.
That's the banks.
yeah,
and,
so
they're paying you.
Yeah. Anywhere from 0.2 to 2%, maybe in the CDs,
Yeah.
maybe.
if you're smart, you get into those high yield ones. Yeah, right
right,
now you get like
right.
4 or 5, maybe.
Yeah, maybe.
But most people are getting less than that, right?
Simple interest.
And
And that's
yeah,
only 4%
taxable.
where people are storing their money, right?
Taxable.
That's crazy. Look at it. That 44% of Americans' money, out of these assets is in the bank
Right.
which is pretty wild. And I talked about a minute ago.
Big number.
How much the banks are not nearly as safe. Yeah, they have the FDIC insurance, yes.
Right.
But just that much money is sitting there earning, low returns and it's taxable.
That's great. Emran, what do you see when you look at this graph? What stands out to you?
Well, like you mentioned, I mean, you look at those, the 401ks and even the IRAs, 28 plus 12. I mean, you're sitting at 40%.
Yeah.
40% of people's money sitting in a partnership with who? I mean, with the government.
Government.
How do we get lulled into these tax traps?
Right.
And I think it's just because people simply they just kind of follow the crowd.
Follow the crowd.
They go to work. Hey, what are you doing? Oh, I'm putting money into a 401k. What's a 401k?
Right.
Oh, well, I guess I should do that too.
Everybody does it.
You know, and it's just amazing how the government has been able to lull the American people into these tax traps. It's okay to have a little bit, but 44% of your wealth in these tax traps.
Right. Yeah.
I'd be careful.
Yeah.
I'd personally be careful.
Isn't that interesting though? I mean, that's a bit 40% in qualified accounts, 44% in banks. Just those two categories alone. If you really look at that chart, that's just two places where most Americans.
And you wonder why people are so afraid of running out of money.
Right.
I mean, if I had my money there, I'd also be worried about running out of money.
Right. Brandon, what are your thoughts on this?
Well, I look at that and I think, okay, what's the best distribution vehicle? As I'm looking at that,
for taking income.
Yeah, distribution, taking income, right? So, am I going to be taxed on it, right? Am I going to take a withdrawal? It's going to come out.
Right.
I get a 1099 from, a brokerage account or the bank, and now it's no longer working for me. I'm just spending it. Or is there something better? Is there something that I could,
There's something not on this pie chart. What's going on with this pie chart?
Reposition that money into something that I can then borrow against it. Let it keep compounding, and growing safely.
Yes.
Right? Cash safely earning. So it's missing something on there, Greg.
Yeah, definitely something. Doug, what are your thoughts? Wrap us up on this.
I'm going to tell you what's missing.
Yeah, tell us what's missing.
What's interesting, and by the way, this is you see that 28% into 401ks, and in January of 2017, I believe, the Wall Street Journal headline was why the original champions of the 401k lament the day they ever came up with this idea. They never intended for it to be the number one retirement vehicle.
Right.
Yeah.
It was supposed
to be companies said, I don't want to give defined benefit pensions anymore.
Yeah.
So let's do defined contribution plans, and whatever they invest in is their problem.
Yeah,
okay.
The start of the end of
here's the issue. 95% of Americans, are in captivity. They will outlive their money. They're going to be lucky to have even $100,000 accumulated, let alone to be able to generate $50,000 to $100,000 a year of income. Okay, this is Americans. It says, where do Americans stash money? This is 95%.
Mm-hmm.
If we were to have a donut, did you notice this is the shape of a donut, Aaron?
Oh, I'm hungry already.
Okay. If you had this chart and it was the top 5% of Americans, the wealthiest, guess where they would have their money? It would be in life insurance. It would be in ownership.
Yeah.
It would not be in banks and 401ks. Wealthy people do not get wealthy in 401ks.
Or checking accounts.
Or checking accounts or savings accounts. They bypass the middleman.
Yes.
Okay, so if this was the top 5%, it would be a totally different chart.
Right.
So if you want to be wealthy and have tremendous financial freedom, don't follow the herd.
Right.
Start thinking differently.
Yeah.
Right? Start thinking differently.
Yes. Think differently. All right. Well, if you're enjoying this content and are wondering how to take advantage of these ideas, at L.A.S.E.R Financial, we help individuals and families like yours implement proven strategies to grow and protect your wealth. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. Don't wait. Take the first step toward a brighter, more secure financial future today. This content also brought to you by IUL Insiders. If you're a financial professional tuning into the show, and we know you are, you're loving this content, but you're also wondering how you can expand your business working with Index Universal Life or IUL, join us for the IUL Challenge. It's a free 3-day event designed specifically for financial professionals who want to master the art and science of IUL. Visit IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. Lost in space, or ocean space, that is. Brandon, we've teased this story long enough. How did you get lost in the ocean? And did you make a best friend named Wilson along the way?
I did make a best friend named Eagle Eyes. No,
Eagle Eyes, really?
Eagle Eyes. So,
Willie.
He was my Wilson.
He obviously maybe not so eagle eyes if you got lost. So.
Well, it was a beautiful day back in the year 2000. I was 21 years old.
Yeah,
I just
pick it up, Brandon. A little
certified.
faster than that.
I was in Cancun with family, and we went. This was my first time scuba diving, and I got paired up. You had to have a dive buddy. So the dive master, who was in charge, don't remember his name, he said, "You're coming with me. You're going to be."
What?
He was your
Yes.
buddy.
What was he thinking?
There was 10 or 12 of us. He looked at me. He's like, "This poor guy. Like, you're with
man.
me."
He saw that Brandon was the one in most need.
Yeah, if
Yeah.
only he knew. If
In
only
fairness,
he knew.
this was our second dive. So we had one dive, like an hour and a half. We came up, filled our oxygen, probably grabbed a bite to eat on the boat, went back down, and maybe 20 minutes into it, I'm exploring all the beautiful aquatic life down there. I got a little carried away and in my exploration, and I got caught in a current, got away from the group, and I tried to fight my way through that current, and it just ended up out in the middle of the ocean underneath. Couldn't find the group, and so
You're like Finding
eventually,
Nemo.
all my training kicked in. I was like, okay, you got to abort. Like you go
Right,
up to
get
the
out
top,
of
you
yeah,
surface,
Right.
look for the boat. The boat was nowhere to be found because the choppy waves.
That had to be
I couldn't
terrifying.
I couldn't even see
Seriously.
the land where the all the hotel strip was, which we were miles off, and so it was like all I could see was water. So
That's when you first realize how big the ocean really
it was
is.
vast.
Oh, man. I can't even imagine.
And
Yeah, that-
all the stuff that's floating, all your hoses that's brushing by your leg, you start thinking it's sharks.
Oh my gosh.
And boy, you
That's
Psyching yourself out.
terrifying.
you pray and pray, and so I tell you, Eagle Eyes, who was on the boat, they all figured they found out down there that they were missing somebody, so they aborted.
Apparently.
And my sister was panicking; she's freaking out, thinking, "How am I going to tell my mom and dad that I lost my little brother?" And it took about an hour, but they finally found me. The guy was like sitting up on the boat as high, like he climbed up on some pole. He spotted me from a mile away, and just like some of this head.
How long was this now?
About an hour.
That's
An
great.
hour. And
hour.
was
Swallowed
that the
a lot of
longest
sea
hour of
water.
your life?
Oh yeah, you lose track of time out there. You literally lose track. You're like,
Wilson.
but here's the bottom line that as I've thought about that, I've thought about the dive master who maybe just maybe it's my fault a little bit, but maybe he wasn't paying attention as much as he should have as to where his first time dive partner was. And as I got lost out there, sometimes in the financial world, you can other people, other IUL professionals can set up plans and then just neglect their clients, their customers. And it's important that you work with people who are paying attention to your plans, making sure you're not just out there floating around, lost, doing this, trying to figure it out on your own. You want to be with somebody that's aware of where
Don't
you're
get
at,
lost.
that's helping you along the way, that's showing you, pointing things out to you. Doug often talks about rebalancing, reallocating. That kind of stuff is really important.
It's interesting that analogy of being lost in the ocean, being terrified, looking around. It's a vast ocean. There's a lot of people that feel like that financially, right? They're kind of just looking around. It just feels like this emptiness, and it's kind of scary. Emran, what's your analogy from that story? What do you draw from that?
If you're feeling lost like that, if you're feeling lost or alone, I mean, it's nice to be able to know, who do I talk to? Who can I call?
Yeah.
And you want somebody in your life that you can call, you can talk to, you can get the answers. Whether that's somebody at L.A.S.E.R Financial, or that's somebody else. Make sure you've got somebody like that in your life that you can rely on. That not only that, but they care enough about you. They're more interested in you than trying to be interesting and getting you to do whatever.
Right.
And that makes all the difference in the world.
Yeah. Aaron, thoughts?
I'm going to twist this on Brandon a little bit.
Yeah, go for it. Yeah, absolutely. He deserves
Brandon
it.
should have taken responsibility.
Aha! Responsibility and accountability.
No, but have a good.
There's a piece of that.
Yeah.
There's a
we need to
piece
talk
of
about the $2 rule one of these days.
I
That'll
take
be
full
awesome.
responsibility for it, for sure.
Just teasing him, but basically, no. Just another take on that is, that we should, definitely take responsibility and learn ourselves. This is where we really pride ourselves on our YouTube channel and our book, the L.A.S.E.R Fund. Is we have so much education to really help you understand for yourself details of IUL, details to understand yourself versus putting all on the shoulders of others as well.
Right.
You want someone that knows it well, like we do, of course, but we have so much education material to help you know the details to guide yourself to, and so you know what's going on, not just relying on somebody else.
Yeah,
so
you're your own best fiduciary.
Yeah.
You really are.
Absolutely. Doug, wrap us up on this, will you? Bring us home.
Should I tell the rest of the story?
Yeah, please do. What's the rest?
I can just. Brandon, when he came to surface, he actually had some binoculars. You ever see The Little Mermaid and Scuttles, and
Using them the wrong way.
yeah, put him on the wrong way, can't see the boat, and all of a sudden, whoa,
Whoa.
what a swim!
He was right next to the boat the whole time. He's there for an hour
I
crying.
wish I had some binoculars.
No, I can relate. I have logged about 500 dives, and I know what it's like to get lost. You don't want to get lost financially. You've got to have someone who is looking out for your best interests and paying attention, like we've been talking about. And so that's what we're very passionate about. We want to make sure that people, their goals are understood and that they have annual reviews. And instead of so many agents, it's slam, bam, thank you, ma'am, and you don't ever see the agent again for 10 years or forever. No. Index Universal Life is incredible. It can perform even if you fell asleep for 10 years, Rip Van Winkle. But if you come in for annual reviews and somebody's watching out for you, it can move from 6 or 7% rates of return up to 9 and 10% rates of return. Okay.
Yeah.
And that makes a huge difference over the long haul.
Absolutely. Okay, wonderful. Well, just a reminder that if you're enjoying this content and you want to see more of it, please like and subscribe. And if you would like to ask us a question, please comment in one of our videos. You may see that question or comment in one of our next shows. Wouldn't that be awesome? Well, that's all the time we have for today. Avoid market fickleness, find wisdom and knowledge, and make the right choices to help your money find a home. Thanks, and we'll see you next time.